As a startup CFO, you know that you have many ways to finance your business. In most cases, since you have a different risk-return relationship or you're facing uncertainty, it is equity capital which you have to use. But equity capitalists have a business model. And that business model is they buy low, they sell high. So they buy shares for a low valuation. But to realize their own business model, they have to sell their shares one day, or in other words, they have to exit one day. And this is also a task for a startup CFO to keep that in mind and to have that in the consideration. If you approach an angel, even if you approach an angel, he wants to exit one day. Even if an angel has more time or a different time frame, if you approach a capitalist, you can see when the fund is ending and maybe there's a grace period, but then after this time horizon, you have to give the capitalist the possibility to exit the business. So whenever one enters here, they want to exit any day, and this day is sooner or later. And you have to realize that kind of exit. So there are different ways to realize the kind of exit. First of all, for the investors, that's the goal, to maximize the return on invested capital. So they love those big exits, IPOs or whatever. But more important than thinking about how to maximize is defining the strategy for the investors. When and how do investors exit a startup? And actually, what we can see, at least here with our startups, is that startups tend to spend many thoughts on their own products, on what they're gonna sell and how they develop their own technology and so on. And they don't think about on building their startup as a product. Because this is important if you have to sell that one day to someone else. And we did various studies on that, and one of the study on business angels, being a little older, says that these exit after 3 to 10 years, which is quite a small amount of time. Some exits last longer, and some bankruptcies there. So even business angels expect exits when they look at the numbers after a certain amount of time. So if you look into exiting a company, the first thing you do is you try to understand the different channels, how you can exit your company. And the first thing you can do is you can sell your company to someone else. I told you our out-of-print book business was sold to Amazon. So Amazon one day bought our entire business and paid out basically in cash, not at the first moment, over time, but that's what they did. That's the first way to exit. The second one, and it also said that we were very close to that, one day, is liquidation, that you might not have the chance to develop your company further, so you have liquidity issues, so you have to make an asset deal, you sell out or you go bankrupt. This is what you don't like, but this is also an exit and might be also a strategy when your company is not going well, if you have assets in your company. But more important for investors in the more positive way are the other ways of doing an IPO, initial public offering. What does it mean? You list your shares to the stock market publicly, so every old shareholder is able to sell their shares after a lock-up period to new shareholders. That's actually the best way for entrepreneurs to remain in control, but give their investors the chance to sell the shares. Mark Zuckerberg, he's still largely in control, but all the other investors had the chance to go out of that business. You can also merge to someone else, to a competitor, to put your company together with them. The question if it is an exit for your investors, or If they just have shares in the new conglomerate, that might be open, but you might have ways to design that. And then there are two other ways. The one is there is a buyout mechanism. So someone buys other investors out of the business. Sometimes also a secondary when entrepreneurs do that. So specific shareholders in a company are allowed to sell their shares and others don't. So it's just an exchange of investors, and the question is, if you do that, you might need another exit then. And last but not least, you might be able to realize a buyback mechanism by repurchasing investors' shares, but this is not really the very interesting way to do that. So in most cases, the most interesting are either selling the business or bringing it public, because then you can realize the highest amounts of money. If you as a CFO go to a potential investor, equity investor, you know that he has to exit, because otherwise he won't realize his deal. Secondly, then, why don't you spend some thoughts on what is the right mechanism? And actually, maybe you want to spend some thoughts on who is a potential investor, because, and that's important, it might affect your business. I'd like to give you an example used for illustration. I mean, everyone knows that Zalando is going public, so there's no discussion, and nobody knows whether Amazon ever thought about buying that company. But imagine Zalando a couple years ago having both possibilities. Either we sell to Amazon or we do an IPO. I could have done both. Maybe could have done both. I don't know. What's the difference there? Well, the one is potentially a strategic investor. The other is a financial investor. And they have totally different rationale to buy a share from Zalando. The one rationale by a financial investor is this is remaining a pure play, like it is today. Zalando has to create more value by working independently on new projects. And only if they have more projects in mind, only if they have an equity story after the IPO, someone is willing to buy. You're not willing to buy shares from a company where all the others say, okay, I'm happy that I'm out there. No, you want to see that this company is still going on creating value, because then your shares will be more valuable after you bought them. So this is a pure play, and the only way it works is there's a value gap, be it top line or bottom line, which you can realize in order to make this company more valuable. And actually that's what Zalando is doing right now. They're creating more and more value, and investors are happy. What's the rationale of a large corporation like Amazon? It's a strategic investor. For sure, he looks at such companies, first of all, on a pure play basis and tries to understand the value of the pure play. But then, in addition to that, these investors have strategic synergies. And that could be top-line synergies, because Amazon has customers and they can shift customers to the new website, and so Zalando would have had higher sales. And it could be bottom line synergies, cost synergies, if they can integrate the databases, for example, and they only need one big database, which Amazon already has, and Zalando doesn't need a database anymore, or something like this, and the cost structure is getting minimal, or cost structure is getting better. So you have higher sales, lower cost, and you can make more money. And actually, the only thing is in that case, then how do you share that synergy profit in that trade sale moment? Is this all being kept by the buyer, or do you get something from that, and so on? Having said that, having pointed out the difference between the potential buyers, it's also clear that if you want to develop your company either towards a strategic buyer or towards a financial investor, you have to develop your company in a different way. Because on the one hand, you have to have an equity story, which you can write and which you can also write when after having gone public. On the other hand, you have to look for the synergies from your top and your bottom line. And you might want to realize those synergies and show those synergies. So you have to find the reason why someone has to buy your company. There can be more reasons, and this is just two from like textbook perspective. I think many companies are also bought because someone is afraid that this company is going to be taken from the market by their competitors, for example. So people are saying two reasons to buy is fear and greed, and most companies are bought because of fear, because someone is afraid something happens to them if they don't do that. But that's a different topic. In general, the important thing is for an entrepreneur, if you go into equity financing, you have to think about also the exit, because it's part of the business model of the capitalist. You think about the exit. Why not spending more thoughts into that? And you can do that by using these 6 tips for your investor contract. First of all, it's about the term sheet. What is your term sheet doing in terms of also thinking about the exit? Is your term sheet able, or are you able to sell your company with a term sheet you designed? That's in general very important. And then within the term sheet, not only the general design, there are contractual clauses like the liquidation preference or the tag-along and drag-along rights. The drag-along right, for example, is the right for an investor to drag you to sell your business. So you know that at least venture capitalists will do that, put that in, because they have to force when the fund is ending. Liquidation preference, on the other hand, is something which might give the investor more money than you if they have a high liquidation preference. Might be dangerous in a case of when the investor has to sell and you don't want. Another point is ensure that it is obligatory for investors to first offer their ownership stake to internal capital holders. So what you don't want, and this is the buyout scenario, that an investor can just go out, and you can also use a tag-along to prevent that, and leave you alone, and you have a new investor you never wanted in your company. So this is a common thing which you put into the contract, but you might want to make sure that this is really in your contract. And the last one is always seek legal review of your investment contract, because this is something which is very important, especially in times when you have to exit the company. So in general, just a couple tips for your investor contract in terms of exiting are mainly look at your contract also from that perspective. Is the contract designed that the company is exit ready? Can someone force the other? Can someone do things against the others? Always careful with those. And I think it's always a good idea for young entrepreneurs or young startup CFOs to seek legal review for that.